You're not imagining it. You're doing the same things you did last year, buying the same groceries, paying the same rent, earning the same salary, and yet somehow it feels like your money doesn't go as far. That feeling isn't random, and it's not because you're suddenly bad with money. Something real is happening to it, quietly, slowly, and most people don't fully understand what it is. The word people usually hear for this is inflation. But inflation isn't just prices going up. It's about what your money can actually buy and how that changes over time. Inflation is what happens when money loses buying power over time. Some prices stay the same, some even fall. But overall, across the economy, things slowly get more expensive. Here's a simple way to think about it. If a basket of groceries costs $100 today, and next year that exact same basket costs $103, that 3% difference is inflation. The stuff didn't change, the basket didn't get bigger. Inflation isn't about one price going up, it's about what money can buy overall. So why does this keep happening? Why do prices seem to drift upward even when nothing about the product itself has changed? There are a few mechanical reasons, and they're easier to understand than you might think. First, imagine there's more money circulating in the economy. When there's more money around, people have more to spend. When people have more to spend, businesses notice that customers are willing to pay a bit more, so they raise their prices. It's basic supply and demand. More money chasing the same amount of stuff means prices go up. Second, sometimes the cost of making things goes up. Let's say there's a shortage of a key material, like computer chips or lumber. Manufacturers have to pay more to get what they need, so they pass that cost along to you. Or maybe wages for workers go up, which is good for those workers, but it also means the cost of producing goods and services increases, and again, those costs get passed down the line. Third, sometimes it's about expectations. If businesses expect prices to keep rising, they raise their own prices preemptively. If workers expect things to cost more, they ask for higher wages, which circles back to raising production costs. It becomes a bit of a self-reinforcing cycle. None of these things happen in isolation. They all interact with each other in complex ways. But the core idea is simple. Inflation happens when there's an imbalance between the amount of money, the cost of production, and the amount of goods and services available. Now here's the part that frustrates a lot of people. Why do prices seem to rise faster than wages? This is where the timing comes in. When inflation starts happening, businesses can adjust their prices relatively quickly. If their costs go up, they can raise prices within weeks or months. But wages are stickier. Most people don't get raises every month. Maybe you get a raise once a year, if you're lucky. Maybe you have to wait for a new job to see a real increase in your pay. This creates a gap. Prices move first. Wages follow later, if they follow at all. And during that gap, it genuinely feels like you're falling behind, because you are. This is also why inflation feels so gradual and confusing. It's not like prices double overnight. It's more like everything inches up bit by bit, month after month. You might not notice that your toothpaste costs 50 cents more, but when you look at your entire budget over the course of a year, you realize you're spending more everywhere, and it adds up. Our brains aren't great at tracking small, incremental changes. We remember what things used to cost, especially things we bought years ago, and we compare that to today. The sticker shock is real, even if the change happens slowly. Let's talk about what inflation does to your cash and savings, because this is important to understand. When inflation is happening, the money sitting in your bank account doesn't grow, but prices do. So the purchasing power of that money, what it can actually buy, goes down over time. If you have $1,000 in a savings account earning very little interest and inflation is running at 3% a year, that $1,000 effectively buys 3% less stuff after a year. The number stays the same, but what it's worth in real terms shrinks. This doesn't mean your savings disappear. It means they quietly lose strength. The number stays the same. What that number can do gets smaller. The same thing happens with any fixed amount of money. If you're on a fixed income or you have a loan where you're paying back the same dollar amount every month, inflation actually makes that payment easier over time because the dollars you're using are worth less. But if you're trying to save, or if your income isn't adjusting, you're on the losing end of that equation. So, is inflation actually the problem, or is it just a normal part of how money works? This is where things get more nuanced. A little bit of inflation is actually considered normal in most economies. Prices going up slowly, steadily, at a low rate is something that happens when an economy is growing. Businesses are investing, people are working, money is moving around. Economists generally see mild inflation as a sign of a healthy, functioning economy. The problem is when inflation gets too high or when it happens too fast. When that occurs, it outpaces people's ability to adjust. Savings lose value quickly. People on fixed incomes struggle. The gap between prices and wages becomes harder to close. That's when inflation starts to feel really painful. On the flip side, the opposite of inflation, deflation, where prices actually fall, sounds good at first. But it can be a sign of serious economic trouble. If prices are falling, businesses make less money, they cut jobs, people spend less because they expect things to get even cheaper, and the whole economy can spiral downward. So, inflation isn't inherently good or bad. It's more about the rate, the context, and whether people's incomes are keeping up. Here's the thing to remember, inflation is a feature of how modern economies work. It's been happening in various forms for as long as we've had money. Some years it's higher, some years it's lower, but it's almost always there in the background. What you're feeling right now, the sense that everything costs more, that your money doesn't go as far, that's real. It's not in your head. Prices have gone up, and if your income hasn't kept pace, you're experiencing that gap firsthand. Understanding inflation doesn't make it easier to deal with, but it does make it less mysterious. You're not being targeted. You're not doing anything wrong. You're living through a shift in the value of money, and that shift affects everyone, just in different ways depending on their circumstances. The goal here isn't to tell you what to do about it. The goal is just to help you see what's actually happening, so when you're standing in the checkout line wondering why everything in your cart costs more than you remember, you understand the mechanics behind it. Inflation is complicated, but the feeling it creates is simple. It feels like you're doing the same things you always did, but getting less in return. That's not failure. That's inflation doing exactly what it's designed to do. If this explanation was helpful, we publish calm, straightforward breakdowns like this each week. Consider subscribing and liking the video if you'd like to see more. It really helps us out.